fear creates opportunity in the markets, but fear also takes out some great traders, right? Takes out some individuals that, are unable to pull the trigger or have certain issues that they need to address before they can take advantage of the opportunity in front of them, right? Now, we know that there are times when markets are extremely greedy, but we're not focusing on the greedy element. We're focusing on where there's fear, where there's volatility, there's choppy markets, and there's fear in the markets. And therefore, there is a lot more opportunity that we can take advantage of. Now, these are the common concerns I often see in traders. The first is over-analysis, okay? I tend to see traders either applying far too much analysis or overthinking their trades. And that happens quite often. So what does over-analysis mean? Well, if I look at your chart and you're looking at multiple timeframes, you're looking at, say, 4, 5, 6 timeframes. You have 5 to 10 indicators on each of those charts, and then you're coming up with different ideas of what could happen. Then I think there's far too much going on. It doesn't lead you to a conclusive decision-making process. So therefore, it's important that you reduce the over-analysis, because they tend to say over-analysis leads to paralysis, that you're unable to pull the trigger because you've got too many ideas in your head, or the indicators are conflicting each other. Yeah? There's no collinearity between those indicators. So you're just going to be mindful of how much analysis you need to do to take a trade, right? Almost you could follow Pareto's principle, right? The 80-20 rule, right? Because 80% of the time, if you do the work in that 20%, the 20% of the work that you carry out, or the trade setup that you apply, that's the majority of the work required for you to be able to make the informed decision. Yes, you can add further confirmations. That should be based on the statistics of your trade outcomes historically. So reduce over-analysis, do not overthink, create a checklist, and that way that allows for better decisions being made. Okay. Another one is outcome is random. Okay, so it's often that I hear traders that, no, I know this is 100% going to go in my favor. I've read this news. This is 100% going in my favor. I've applied this analysis. This is 100% going to go in my favor. And then they might bet the house, or they might, take far too many positions on at the same time, and they get into a trap of thinking that they know the market is going to do something, and then what they end up doing is it starts to go against them, and they hope that it's going to recover, and then they hold on to those losing positions, and they fall in love with these trades, right? So ultimately, outcome is random, right? It is random, but at the same time, you can increase the probability of your setups. Okay, that's the goal of a trader, is to increase the probability of your setups, where you have something that meets, say, out of your checklist, you've got a checklist of 7 sort of key points that need to be met. 5 is met. That means you can sort of, take a trade at this risk amount. If 3 is met, then you're like, nah, I've not got enough confirmation to take this trade. So know that it's all about probabilities, right? Similar to how, poker players, they know their hands, they know what hands and their probability of those hands. That's how you need to know about your strategy and the types of setups that you're looking for in the markets. So think in probabilities, not in guarantees. Yeah. And do remember, market dynamics change on an ongoing basis. All incoming information is going to lead to fluctuation in the markets. Markets don't move in a straight line. Okay, so knowing that markets changes over time, new news comes to light, and you'll see fluctuations, and you need to adjust yourself going forward. Accepting the risk. Unable to trade due to the monetary loss or the monetary size of that position. Now, first of all, you need to accept losses, right? Losses is part of trading. That's the first key point, right? So you got to accept the fact that you are going to take a loss, right? You are going to lose a trading position, right? There is, a perfect example is that I had a loss on that Saturday morning. When I looked at my phone in the morning and I had a trade on Bitcoin, I had a loss on that trading day. Now, I had no control over that market. I was seeing that more of a swing trade, and it went against me. I had a stop loss. I've managed my loss, right? So I have managed to take a small loss. Okay, move on. What did I learn from that? Is this something that I could have done better? Right? Maybe I didn't, set an alarm to keep me sort of in the loop of is some sort of price occurs, right? So yeah, so you've got to accept a loss, but then you've got to also accept the risk that you're taking for that potential loss as well. So if you're risking $100 per trade, or you're risking $1,000 per trade, well, are you comfortable losing $100 per trade? Are you actually comfortable losing $1,000 per trade? Because there's often times where the trader gets into a trade and he sees a little red candle go against him, and he's like, oh no, okay, I'm out, right? And that's not the correct decision processing to make, right? Think about all the analysis you do, look at the multiple timeframes, you apply all the indicators, you lead up to your higher probability setup, the confirmations that you apply, and then you execute the trade with good, risk management, good psychology, and your position sizing and so on. And then all of a sudden you see one red candle and that's made you trigger out the trade, right? That's not good trading. That's not good trading, because you should be prepared to take that loss. If it goes against you, that's fine. I'd rather it go against you and you take a lesson from that and improve for the next trade, then take cancel your trade, close out the position, and then say, yeah, I did the right thing, and then move on to the next trade. And you're going to get into a habit of doing that regularly. And what you're going to have is these very small wins, and you might have these large losses that occur, or you will have no wins, and you're just going to have constant sort of, these small losses all the way through, and you have maybe one that goes in your favor, right? So just be mindful that you've got to accept the risk associated with trading, right? Don't assume that all trades are going to go in your favor. Pulling the trigger, not able to execute, as he does not want a loss, or he or she does not want a loss. Now, that's another thing, is that I see individuals that will, they are likely to look at the markets and they have everything matched up with their checklist according to their trade plan, their risk parameters and position sizing is all correct. They are about to execute the trade, and then they have this last second doubt. They have a last second doubt that takes place in them, and then they don't take the trade. And then they step away, they don't take the trade, they come back, they have a look at the trade, and they went in their favor, and then they have regret. Yeah, so you've got to pull the trigger, right? You've got to pull the trigger. And the quickest way to fix that issue is you're probably trading at a larger size than you're willing to risk from a sort of behavioral standpoint, right? So that risk you're willing to take is far larger than you're willing to actually place emotionally and psychologically. So therefore, reduce the exposure, Take a half the size lot. At least you execute the trade. Take a quarter the size if you need to, but you need to be pulling the trigger. Remaining focused, unable to find trading opportunities. Yeah, this is another question that I tend to hear from traders. Now, what I often find is it's not the focus, right? So it's very easy to sort of, you don't need to be 8 hours of focus throughout the trading day to trade, right? You're gonna have moments where you have to maintain focus. I'll say about 10, 15, 20 minutes. Then for another 20 minutes, 30 minutes, you can relax, sit back, do what you need to, and then you look for the next part. And then it's sort of on and off. It's on and off throughout the trading days when you'll have that focus and you have that tunnel vision. You're implementing everything you need to be according to your trade plan. So that's probably sort of outline that schedule, right? Set alarms on your phone. That's something that I do now, right? I need to be at my trading desk 10 minutes before the open for both markets, the US markets and the London Open, and I set an alarm, so that I know that I never miss that open, right? Because I can get carried away doing something else. So just by setting an alarm for what to allow you to sort of focus. There are little clocks that you can buy that allow for time blocking, right? So you can time block every hour. But again, it's up to you what method you want to use. But that should be a very easy fix. What most individuals struggle with is unable to find trading opportunities. Generally, it falls down to not being consistently applying your trade plan. Okay, so what that means is having a morning process, having a pre-trade checklist, and then in-trade checklist, and then what do you do at the end of the day with your reviews as well. So having a routine is very important. Reducing the number of timeframes or assets you view is also an important factor. So I find that some individuals look at too many assets, and if you're looking at too many assets, where is your focus, right? You might find that you've missed an opportunity on that asset because you're analyzing this asset. So start with a select few of assets that you want to trade and the specific time frames that you want to trade within those assets. And then over time, you should sort of, look to branch out and then include more assets if you need to. If you're looking for more trading opportunities, or you're looking for something that's not correlated to the markets that you're trading, so that you don't miss out on other trading opportunities that occur in the markets, then you could look to expand that list. But there are traders that I know that really specialize on a select few assets. Remaining focused, okay, so that's been covered there. So missed the trade, often missing opportunities. Similar to what I've just covered now, right? So unable to trade and find opportunities, but at the same time often missing opportunities. Well, if you've reduced the amount of assets you look at and the timeframes that you view, then I'll probably say is that you're not setting up alerts. Set up price alerts. Okay, so once you've done your analysis and you know that, okay, this is what I'm looking to execute roughly, set a price alert so that you get a trigger. You know that when prices reach that point, and then you can come to that chart. So setting price alerts is for sure the quickest fix to that particular concern of missing trades. Okay, just making sure, right. Okay, moving on. Now, when there's a lot of volatility in the markets, sometimes it can be very easy to overtrade or revenge trade, and just trying to do the opposite of being fearful of taking a trade, is actually becoming far too aggressive and just overtrading and revenge trading, right? And it's important that you step back, and then adopt a big picture perspective, right? What's leading to these markets being risk off or risk on? What's the key factors behind them, right? So, stepping back can most certainly help you in minimizing when you're those over trades, when you take far too many trades, and then you dig yourself into a hole, and then it just gets a larger and larger hole as you're over trading. You look to make back what you lost early on in that session. Yeah, so just limit the amount of trades that you take, especially when there's a lot more volatility in the markets, right? So, I mentioned over here, you can see periodic market volatility or pullback is usually between sort of, somewhere between 5 to 10% is a pullback, is what from the peak. Market correction down somewhere around 10 to 15% in that range there, but a bear market's 20%. Okay, so once you have a sell-off of 20%. Now, yeah. Just remember that markets don't go up in a straight line, okay? They go up over a time period. So don't just be panicky and trying to jump into trades without doing the right work and the due diligence behind that, okay? So if you're long only, if you're looking to just take long trading opportunities, right, then, okay, and you may already have some open positions, reduce your position sizing in volatility, in times where there's a lot more volatility. You don't need to take the equivalent risk as you previously did in a market that's not as volatile, right? So you could make the same amount of gain with a smaller position size when the markets are volatile. So reduce the position sizing, right? So you're applying less risk in the markets, but you're going to potentially make the same amount of gains as you previously did. That's the idea with reducing the position sizing during volatile periods. Now, there is a very strong theme of buying the dip. Okay, so now this is all about market timing. Okay, so it's about learning to time the market where you can buy the dip. And I showed you, for example, the president of El Salvador. He's timing them. He's trying to buy those dips. Okay, so he's timing the market. He said he's out by 7 minutes from the low. Okay, so hey. Some traders can do it, some find it a little bit more tricky. You've got to have your specific strategy on how you buy the dip and how you class the bottom of that dip and to time that dip. But certainly buying the dip is a great opportunity to buy prices at a much better valuation, okay, much better value. Dollar cost averaging is a methodology used by mostly investors and portfolio managers. Now, this is something that you could apply where we know that there could be some volatility for some time period. And rather than actually get into a trade instantly as soon as you see the sell-off, sometimes you might see, like we saw with the Bitcoin price, we had a sharp drive lower, then back onto this sort of midway point, and then it's trending sideways, and then it might slowly start to move lower, 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 test those previous lows again, and then you start seeing more buying stepping into the markets, right? And I've seen that often occurring. So, don't be so quick to jump in on the bandwagon straight away. Maybe stay out of the market for a day or two, see how markets are reacting, and then look to maybe add positions, very small positions, over a period of time. Okay, it could be throughout the day, it could be throughout a few days or a few weeks even. If you're looking to go short, if you're looking to, you've stepped back, you've taken that bigger picture perspective, and you think that we're going into a bear market, or we're going to see more downside moves occur in the market, and of course, then the goal should be is to take some shorts and maximize the opportunity on the downside. And that's where you should be looking to short every rally. Okay, so look to short those rallies, and they call them a dead cat bounce. So just be mindful, maybe do some research into a dead cat bounce. And how you would cover and strategize around that. I'll probably cover that in another session, go into a bit more detail around that. But yes, the goal is that every time you see a bit of a rally coming up back to those previous highs or back to a moving average, look for a bit more selling pressure to step in, and then you execute those trades. A very good incentive is to look at the volume indicator. The volume indicator will quickly outline how much volume is coming into the markets when it's a bull trend or a bear trend. Okay, so when you're seeing a bullish rally or a bearish rally, you want to see on the bearish rally larger volume in comparison to the bull rally, weaker volume. So yeah, overall, don't panic. Let me just minimize myself a bit there. Yeah, so don't panic. Stay disciplined and look for the investment opportunities that market lows can present. Those are fantastic opportunities because you're buying assets at great value. So yeah, for sure, use those opportunities. Okay. Okay. What we have here is, okay, let's just go into a bit more of the psychological elements that I tend to see that have an impact, especially around these types of situations. So there are two cognitive biases that, will not help you, and you need to be aware of them. It's important that you're aware of these psychological biases that would impact you, okay? And these cognitive biases, the first one is the loss aversion, which means that when an individual does take on a loss, they feel that loss somewhere between 2 to 2.5 times that amount, or strongly, in comparison to the equal amount of gain. Okay, so losses impact us more than winners. Okay, losses impact us more than profits, and you've got to be aware of that, right? And what I would recommend is, okay, when you have a loss, step away from that trade for a little while, come back, reevaluate with a fresh mindset. Think of it as okay, my task is, okay, I've paid my dues to the market, I've taken on the loss, I'm going to take a golden nugget from this, of something that I can learn from here for the next trade. And that's what you should be looking to do. Now, the second concept, or the second sort of bias, is anchoring, and I see this a lot. I do see this a lot. So what happens is that you might be on a, say, 50K account or 100K account. And over a course of 3 months, you've, let's say in the Q4 of 2021, so October, November, you've done very well. You've done those, in those 2 months, you've done very well. And you've gone from 100K to, say, 110K, right? And that's your highest sort of equity balance, right? Now you're 110K, and then in December, first, bit of a sell-off is occurring. You've taken some trades. As trades have become a bit of a mostly losses, and now you're down to, say, 105. You're down to 105. Now, what ends up happening is most traders, in their mindset, is that they end up now, because they want to close the year in a profit, and they have it in their mind that they were at 110, right? That's where they want to quickly get to. They overtrade. They start to risk more, and then they end up maybe even losing more. Okay, and therefore, don't see that as the way. That's not how you should actually view it, right? What you should view is, okay, I've done great in October and November. December's not starting off such a great month. I've given back the profits I've made to the market, and I'm still up 5K. I'm up 105K from where I started, 100K. at the beginning of that quarter. Yeah. So take it into perspective, with every month or every quarter, what your starting balance is and what your ending balance is at the end of the month. And don't be too fixated on that highest amount, your high watermark amount, right? There's a famous story of a Wall Street sort of pit trader who was doing exceptionally well. He's earning quite a few $1 million, trading the markets on a specific year, and he is just I believe it's like $20,000 or $30,000 away to achieving enough capital to buy himself a boat. Okay, in that last month, of that month of December, because of he began to overtrade as it became a down month for him. He ended up giving his entire amount of gains he made in that entire year back to the markets, just because he had a vision that he wanted that boat by the end of the year. Yeah. So don't be that guy. Don't be that guy, right? Set realistic goals. Have a look at where you started from at the beginning of the month or beginning of the quarter, and see where you are now. Reevaluate from that point onwards. Okay. Every day when you come to the market, you should look at your equity, whatever that equity is. This is where I'm starting from now. Don't think about, okay, yesterday I was up, this amount. I want to quickly make that back now, right? It's not going to happen. Don't think like that. That's when you tend to make a lot more mistakes. Okay. So what not to do? Well, I often find individuals that they keep checking their trades, right? You've got maybe you might have a day trade that you're thinking that's going to last about 6 to 8 hours, or you might have a swing trade that's going to last 3 to 4 days. And, that day trader is checking his trade every second. He's just visually just looking at the markets the whole time. You can't do that. That's just it's going to freak you out at some points, right? You're going to see some candles that go against you, and it's going to sway you, and you're going to start talking to yourself and saying all the negatives you can do to get yourself out of that trade and lock in that small profit, when if you just left it, it would have just gone to hit your target, right? And same with the swing trader. Swing trader's got to trade on for 3 to 4 days, and he's checking it every half an hour. No, you don't need to do that. So don't check those trades so frequently. Predefine how often you're going to check those trades, and be consistent with that. This is, they say the 3 best traders are woulda, coulda, shoulda, right? Now, this is about regret. Okay, this is where you often find that individuals will, often say, "Oh, I could have done this. I would have done this." I actually had someone that messaged me yesterday, and they said, "I really believed in the trading. He had a trade in Ripple. I really believed in that trade on the Friday. Took the trade, and then what happened on Saturday? I can't believe it. This could have happened. This should have happened, right? But that's in the past now. It's in the past. It's history. You can't control markets. Don't have a stoic mentality almost, right? Where you can only control what you can control. You can't control the markets. So, don't. If you find yourself saying those 3 words, woulda, coulda, shoulda, then think again. Go back to review those trades. Take something away. Move forward. Don't have regrets. It's important you don't have regrets. What you should be looking to do is remain calm, be in a relaxed state, think methodically, review your trade plan. Writing notes down is very important. Just having a pen and paper, writing notes down and writing what you're looking to do has so much more of an impact, and you're more likely to stick to those words, stick to those points that you've written down when you trade the markets than just think it. Be patient and wait for confirmations. Okay, so I find that traders that are able to, step away, be patient, calmly, sort of, wait for confirmation is a much better tactic to apply, especially when there's volatile markets. Okay, so this little image that you could see over here, what we're seeing is, when the markets are bullish and is moving higher, and then you'll just keep buying at those higher levels, right? That's where your greed's coming into light, and you're excited because you can see the gains that you're going to be making. So that's where you've got to manage that mentality, that emotional behavior. Same time, the opposite, when the market's moving lower and you're selling, or you're taking those profits, and you're booking those losses, you've got fear and anxiety, and you're unable to take the next trade, or you're short of the markets, and it's going in your favor, but you're just getting more and more aggressive and adding to those position sizes, and then all of a sudden you have a snapback, right? And it snaps back, and then it stops you out, and then you're trying to look for the next short again. That comes with just traders being panicky and rushing into looking for valid opportunities. Yeah. So, Warren Buffett often says it's the impatient always gives their money to the most patient. Okay, and that's what's going to happen in the stock market. It's the impatient that gives their money to the patient investor or the patient trader. So remain patient. Don't rush the process that you are focusing on based on your trade plan. Okay, we're almost there, guys. Just give me a moment. Okay, so the process, and I've put it into sort of 4 steps here, 4 steps, right? On the right-hand side is what you should not do, and on the left-hand side is what you should look to do, right? Let's start with the right-hand side. So this is an individual who reacts compulsively. He's just jumping on trends and, he fears missing opportunities, okay? So what he's doing is he takes opinions as facts, right? You've got to know the difference. It's important you understand the sentiment in the markets, you engage in these views in the markets, but you don't take them as facts, right? So instead, he's following rumors, right? He's taking these rumors and he's believing in them and he's applying those trades, right? Considers the upside and maximize exposure. Now, I did mention this in one of the previous sessions, right? As a trader, your first goal is to survive in the markets, okay? Being able to survive, and that means having good risk management, right? Don't just look at the upside, look at, for the upside, what is the risk that you're likely to take, okay? So don't get overexposed, don't take considerable large risk in the markets just because you think that you can make this amount. Also think about what you could potentially lose as well. And this trader will enter risky positions. And in most cases, the psychological elements will make it worse for him because of the exposure he has in the markets. He's going to be very panicky and he's going to look to close out as quickly as he can with small profits. And he's just going to repeat this process over and over again because he has no plan. He doesn't log anything, right? He doesn't, take snapshots, and it's just FOMO, right? FOMO is taking over, fear of missing out. Okay, so that's what you don't want to do. What you do want to do is plan your trades, keep a journal, and develop confidence in your own strategy and you as the trader, right? You're the individual, you're the person that's applying the strategy. The strategy is nothing without you. So therefore, you need to be pretty much solid, right? You've got a methodology, you've got a process, you've got a trade plan, you've got a journal, and you're following all the right steps. So the trader with a plan is going to conduct his analysis and he's going to follow the news. He's going to know the difference between what's a fact, what's a rumor. He's going to just follow sort of the key themes that are at play and then apply his analysis. He's going to set comfortable risk to reward ratio trades. Okay, he's not going to over leverage himself. In fact, he'll do the opposite, right? He will, in times of volatile markets, he's going to reduce his position size because he can make the equal amount of gain, as I mentioned. So he will set up his risk reward in line with what the current market conditions. And he uses realistic and sensible stop loss and take profit levels. He's not going to assume the market, like this in the crypto space, to the moon, or, well, that's more for Wall Street bets types of sort of groups that are looking to, get into GME and hoping for the moon type of situation, diamond hands and all that stuff. Okay, that's fair and well. But ultimately, the majority of those Wall Street bet group had taken a substantial amount of losses. Very few made a large amount of profits. That's just the nature of the business. But at least one of the key benefits of that is the next generation of traders or market participants have quickly got schooled in risk management, right? And risk is important. You should be able to take risk in the markets, right? And learn from your mistakes. So yeah, follow a plan, keep a log and achieve those trading goals. That should be your, that's the focus. Have those long-term goals, assess yourself on an ongoing basis, follow the plan. As I mentioned, don't put too much emphasis on your final equity or your highest watermark of your P&L or your equity balance. Look at it on an ongoing basis based on from where you started to where you end on a monthly or quarterly basis as well. And this should help you maintain a little bit more structure in the markets, have more confidence in yourself, in your strategy. Be methodical in your process, and for certain, this will allow you to become consistently profitable in the markets.